Welcome to your Mortgage Insider Update, July 27th. July is nearly over, and that means that the last Federal Reserve meeting for the next 6 weeks takes place. They take the month of August off, and we'll meet again in September. That leads up to some usually groundbreaking speeches that will take place in Jackson Hole, Wyoming. It will take place at the Jackson Hole Symposium later in August, where World Economic minds and other central bank leaders will be there delivering mini speeches. We do expect Kevin Warsh to make presentations in August, so there will be news next month. But this week, the news is the Federal Reserve meeting and the uh, pause in Middle Eastern conflict as about 12 days worth of strikes from the U.S. In response or to the response of Iranian strikes and just more trouble in the Middle East as oil prices did spike this last week. They have since subsided a little bit with the tensions slowing down. So let's take a look and see where this lands us after a spike in interest rates. Hopefully, we've seen lots of spikes in the past and they go up, they come down. Hopefully, we're in the down cycle this next few weeks, but we will see. Take a look. Share sound, optimize. As we often do, we share the 10-year Treasury as our first barometer for the direction of interest rates. Obviously, the rate the government's paying on their longer term debt does give us direction on which way longer term interest rates are trending. So the 10-year is down today, well above where we were just a couple weeks ago. I mean, this was below 4.5% just recently. So So I'm going to display a 2-year look back on the 10-year Treasury just for some context, and we'll get into the specifics of the last few weeks. But we did stop at this retracement line. Now we can see this was breached back in January 2025 briefly, and this is where I'm coming from with the ups and downs and rates. It spiked at the beginning of that 2025 year and fell off significantly into March of that year. So that first 4 months in 2025, we saw quite a range in the 10-year Treasury. It never does it travel in a straight line. There's lots of ups and downs along the way. So this blue line is the 200-day average, gives us the direction of where rates are headed, or they've been heading over the last 200 days. Of course, there's the 50-day averages, and most specifically, the 25-day average gives us the current term. So getting into the 3 month or 90-day window here, we can see that we are at the high point over the last 90 days, exceeding the rates that we had back when the skirmishes in the Middle East had spiked up again in mid-May, only to subside after some ceasefires were successful in the short term. The 25-day average was on the rise. It dipped a little bit, and we can see that just most recently here, we're back on the uptrend, but we are at that, like I said, 2-year high point where this has been toyed with in the past couple of years. Hopefully, this will be a trend to the downside. We do have a ways to go to even reach anywhere near where we were back in just the end of June. This would be a happy place, which would be right around the 25-day average, getting back below that 4.5%. But that will be tough in the absence of major news. Now, this Federal Reserve will be making some major news, hopefully by not changing their interest rate guidance. There has been a lot of debate over whether the Fed would raise rates this year in response to the spike in oil prices, inflation that's come with that. But we will see on Wednesday. So keep an ear out for that. There will be some inflation numbers with the PCE, the personal consumption expenditure. Now that goes back to June. So that's going to be a little bit dated information. We did see consumer price index fall in June. that was after we had seen a reduction in interest rates. After the spike in May, we'd seen things come down through the month of June, only to now trend back higher in July. So we will see what their response is. And briefly, I'm going to touch on the mortgage-backed security. Now, the security price is what the investors pay. So the higher the price they pay, the lower the net interest rate to the consumer. That's why the 10-year Treasury gives us a better barometer. But just for context here, the price going up means investors are bidding on these mortgage-backed securities. And we can see the bottom, so the low point where investors just this last week stopped paying into the mortgage-backed securities, that brought interest rates higher. So the price fell significantly. We hit a bottom very similar to what we just saw on the 10-year Treasury, that has been a bottom for the last couple of years. So a push higher in the price to the mortgage-backed security, the bid to the mortgage-backed security, can continue to bring consumer interest rates down. But this is at a point where we're still not, at levels that we'd like to be at, which would have been like back in early to mid-July, or of course the prices back during the ceasefire times, with Middle Eastern tensions depleting, and then of course it's all kind of fallen apart over the last couple of weeks, and that's where we've seen the interest rates spike. So as always, we're keeping an eye on this. We'll come up with a video and update to our newsletter every single week. If you want to subscribe to the video, so subscribe here on YouTube, or follow us. There should be a link to there's a link to the newsletter in the description. Feel free to check on that and get your updates. Have a great week.